What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my stock market monthly update series where I give you guys a quick rundown on everything that's going on in the stock market and the economy at large. Now, I'm a little late this month. I normally like to get these monthly update videos out at the start of the month. But as you know, I recently announced that I will be going all in on YouTube, leaving my college teaching career behind. So things have been a little hectic. I've been a little busy setting everything up and with Patreon and Discord and other stuff, just kind of getting everything in motion. But I am here now, and I can't wait to do our monthly update video for the month of May 2023. And by the way, I love this series. It's one of my favorites. We get to cover a lot of different topics all in one video. It's a lot of fun. And right now, I would say that the topics that are on most people's minds is probably Q1 earnings season. Most companies have reported already, so we'll be talking about that today. We'll also be covering, of course, the economy. We'll talk about where we're at with inflation and interest rates. Of course, the Fed just held their most recent meeting just last week, so we'll talk about that too. And we usually separate these videos into 3 parts, so we'll do that as well. We're gonna cover part 1 will be stock market performance. Then we'll go to part 2. We'll talk about any stock market news, earnings, interest rates, all that kind of stuff. And then in part 3, we'll finish up with the biggest gainers and losers over the past month for individual stocks. And I'll let you know if anything catches my eye there as well. So it's a lot of fun. Hope you enjoy it. But let's just go ahead and jump straight into it. All right. And starting first here with market performance, things have been a little volatile this year with the S&P almost flat in the past month, but it is up almost 8% year to date. Not a bad start to the year, although it is still down almost 15% from the top, but overall not very bad performance from the S&P. The Nasdaq, however, is a little different. Also the high volatility and almost flat in the past month. However, year to date it's up a monstrous 17%, and yet despite that really strong start to the year, it's actually still down more than the S&P from the top at over a 25% drop, which is technically still considered a bear market, being down over 20%. So overall, a lot of volatility all around, and you especially notice that with individual stocks too. Like if you look at some individual stocks, there's many out there that have already very largely recovered back up to trading near all-time highs, while many other stocks, especially in like tech and I would say the financial sector too, many of those stocks have gotten crushed. Some stocks are crashing by huge amounts, still down huge. A lot of international stocks too. Many stocks are trading near decade lows, and some dividend stocks are even yielding the highest yields maybe in their whole entire history. So there's a lot of variety out there because of all the volatility. So I would say that this is really kind of a pick and choose type of market environment, which I kind of like myself, because you can kind of get whatever you're looking for in this type of market as long as you're willing to search it out. Like if you're looking for some strong performers that continue to trade higher and continue to perform well, we've got that. If you're looking for some deep discounts, if you're looking for some stocks that are heavily beaten down, you want some real value, or maybe you want some dividend stocks with some really high yields, we've got that too. If you're looking for speculative stocks, anything you're looking for, growth, value, whatever it is, as long as you're willing to do the research and search those stocks out, you're probably going to find them in this kind of market. And so that's a market I like. I always welcome the volatility because it just gives me more opportunities to find what it is I'm looking for. You need that volatility in order to get that. And we definitely have that now. Now, of course, a lot of that volatility is based on a lot of fear, because we could have a looming recession right around the corner if we're not already in one. Of course, the economy is still very weak, at least in my opinion, and we have rising interest rates. And of course, we know that rising interest rates do have an inverse relationship with stocks. Usually higher interest rates, stock market is going to struggle. If you're lowering rates, stock market will tend to perform better. That's kind of historically speaking what usually happens. And right now we're in a rising rate environment, and that also threatens a recession too. So that's why there's a lot of fear there. Let's take a quick look at what's going on with inflation and interest rates. Let's just take a quick look right now. Well, on the inflation front, numbers have actually been improving for some time, as we have now reached our lowest inflation rate in nearly 2 years, after March inflation came in at 5%, which is a dramatic decrease from the 6% in the previous month and the over 9% high of last year. April numbers should be coming in this week, and if the downward trend continues, then that would likely be seen as a clear indicator that all the recent hikes by the Fed are indeed working. Speaking of which, last week the Fed decided to raise rates for the 10th time in a row, bringing our range up above 5% for the first time since right before the Great Recession. So it is pretty high. Initially, this spooked investors because increasing this sharply usually causes a recession, but when the Fed later hinted that they may be pausing rate hikes going forward, the markets bounced back up in reaction. See, the Fed actually removed language from previous statements saying that they anticipate additional policy firming. So, removing that language suggests that as long as inflation continues to drop, the Fed may actually ease up on interest rates or at least pause the increases in an effort to avoid causing a recession. As it stands, though, the job market is actually defiantly strong, surprisingly. In fact, we're seeing decades low unemployment, and as long as it stays this way, I would imagine that the Fed is not going to want to lower rates just yet, because the longer that it can hold on to those higher interest rates, of course, the more that it's going to bring down inflation, and it does really want to get it down to their target rate of around, I think it's like 2% right now for inflation, that the Fed's target rate. So that's what they want to get to. Now, I think the real question on everyone's mind is whether we end up having a soft landing coming out of this, or maybe a hard landing crash. And in my opinion, it could really go either way at this point. I mean, if you're looking for a soft landing, of course, you'd want to see inflation continue to plummet, and maybe you see a little bit of a dip in employment. Then the Fed is convinced to lower interest rates a little bit. They may not need to have them so high. Guys, when you have high interest rates, it's going to really slow down the economy. It's going to slow down spending and borrowing. So you don't want to keep interest rates high for too long. So that may convince the Fed to kind of lower interest rates a bit. If the economy is still relatively stable, then you may end up coming out of this relatively unscathed. That's where you have your soft landing, so to speak. On the other hand, there are many pockets in the economy that have heavy weakness right now, and just some that just come to mind would be like the tech sector. We've seen massive layoffs across the tech sector, had a lot of growth during the pandemic, now not so much. We've seen weakness in parts of the financial sector. Advertising market, you've seen companies reporting earnings saying that advertising budgets are down, and other companies, their advertising sales are down. There's not as much demand. So that's a clear sign that the economy is slowing down. When advertising takes a hit, the economy is taking a hit. And so we clearly do have weakness in the economy right now. And even show you more in earnings. We kind of have an earnings recession right now. I'll show you that in just a second too. But the point is that if you continue to have high interest rates and maybe inflation doesn't come down to their target rate, they continue to have high interest rates. You could absolutely send the economy into recession, and then the stock market would obviously probably take a big hit there. But longer term, I'm just not really worried about any of this. I actually kind of like this environment because we have a lot of volatility in the stock market. I'm able to pick and choose like so many great stocks at good prices. Whatever it is that I'm looking for, I can usually get it. And longer term, we have the ammunition of high interest rates in our back pocket that we can pull out at any moment. Regardless if you have a soft landing or a hard crash, the Fed will be able to lower interest rates because we have them so high. And that will boost the economy, that will boost the stock market. And so looking out years from now, I mean, I can almost guarantee that the stock market is going to go higher years out from now. Obviously, that's not the entire picture. Obviously, there could be outliers. There could be a war. There could be a pandemic. There's many things that could derail that. But I'm just saying, in the general sense, I would expect the stock market to still go up over the long term. So I'm still a buyer. And if we have a crash and stocks go even lower, and I'll probably be buying more. Of course, I'm buying very carefully. I'm not going out there and just throwing all my money around. I'm buying slowly in small amounts. I'm picking and choosing. I'm doing my hard work, my research, but I am still a buyer of stocks. That's just my opinion, though. That's just what I'm doing. You guys make your own decisions. Anyway, with that said, speaking about individual stocks, we of course have most companies reporting earnings this past month or so. So let's go ahead and cover earnings right now, and then we'll finish up the video with the biggest gainers and losers right after. All right, now taking a look at the earnings, they actually looked much stronger than initially anticipated, as FactSet is reporting that 85% of S&P 500 companies have already reported, and so far 79% of them have beat on EPS estimates, while also 75% beat on revenue estimates. So that's pretty big, guys. That's very strong performance there, at least compared to analyst analyst estimates. Now, that doesn't necessarily mean that the economy is strong, though. In fact, we're actually in an earnings recession right now because Q4 of last year and Q1 of this year are both looking negative. So that's 2 quarters in a row of negative growth. However, the good news is that it's still much better than what we thought it would be. In fact, we thought we were going to have a negative 6% drop, but so far it's only around 2%. Now, looking ahead, it's a bit of a mixed bag right now with 44 S&P 500 companies issuing negative guidance, while 35 are issuing positive guidance. So still more negative than positive, and that's why I continue to say that we're not out of the woods just yet. The economy is clearly struggling, and a recession is definitely still on the table, but I think things will get better over time. I think the second half of the year will probably be stronger, especially with earnings. Individually, though, we had some of the most popular stocks reporting, with most of them beating expectations. Microsoft beat on both the top and bottom line. Same thing with Google. Tesla was about the same as expectations, but did suffer an over 20% decline in profits because of mostly higher commodity prices and underutilization of their factories. But I do expect that to improve once their newer, more profitable factories get ramped up. Now, Facebook and Instagram parent company Meta did very well, beating EPS by a double-digit percentage. Amazon destroyed earnings, beating EPS by over 40%. And most recently, Apple came in with another strong quarter as well, beating on both the top and bottom line. Even banks were stronger than expected too, with Chase destroying expectations, beating EPS by over 20% and revenue by over 7%, partly because of higher interest rate income, but also because of the migration of safety from customers that are moving their assets into larger, more trusted banks. So smaller banks, we've seen a lot of them struggle. Bigger banks, perhaps maybe gaining some of those customers from them, which is why the second largest bank in Bank of America also topped EPS by almost 15%. Citibank beat by almost 30%, and while US Bancorp saw a much smaller beat, they did, however, still experience a noticeable flight to safety and to larger banks as well, with a modest increase in their total deposits. And yet most financial stocks continue to fall despite that stronger performance. But that's okay. The collapse of Silicon Valley Bank and a few others is still fresh on everyone's mind. There's of course that risk of recession. Of course you're going to see financial stocks struggling right now. I think longer term, they'll mostly be fine, especially the bigger players. I'm buying some US bank stock myself in small amounts. I don't know. I like it. But that's just kind of how I feel about all of that. Anyway, with that said, let's go ahead and finish up the video now with the biggest gainers and losers over the past month. I'll let you know if anything catches my eye there as well. Okay, well, right off the bat, I see the online shopping platform provider Shopify as one of the biggest gainers this past month at over a 40% rise. And that's mostly because of better than expected earnings, beating EPS by over 120%, but also because of a major change to their business, announcing that they're selling off their logistics business in order to improve their profitability margins, which by the way includes a 20% reduction to their workforce. It's a fun spec stock, but it's always been too expensive on the valuation side for me personally. Another popular spec stock that shot up this month though was the online sports fantasy and gambling app DraftKings, who soared by almost 35% after beating estimates and also raising their full year guidance, saying that they expect substantial improvements to their profitability with break-even adjusted EBITDA coming in as early as the next quarter. I love tracking this high growth stock and I'm happy to see them improve margins as they usually lose a lot of money on the bottom line, sometimes even more than they do in sales. But I don't own this stock myself personally. And the cruising giant Royal Caribbean also gained close to 30% after not only beating estimates, but also posting huge gains year over year of over 170% growth on sales and almost 100% growth on net income as well, although they are still technically not profitable. But these are huge improvements coming out of the pandemic, and they'll probably continue to grow throughout the coming years because of it. But they are, however, already trading at a 52-week high after climbing almost 60% this year. So I would say it's a lot less attractive now, but they are still down almost 30% in the past 5 years. So, I can understand why many are choosing to invest in it, but I don't own it myself. Scrolling a little further down, Molson Coors also soared by 24% this month, which probably has a lot to do with the recent Bud Light controversies that they might be benefiting from as a competitor. We also had the speculative ride hailing app Uber climb by about the same amount after beating earnings. And the popular Mexican food chain Chipotle also experienced similar results as well. I don't own any of those three stocks myself, though. I just feel that there are much better options out there with cheaper valuations and more stable businesses. Scrolling a little further down, another popular spec play, Airbnb, climbed over 15%, which I do like this one, but I already have too many spec stocks as it is. However, two stocks that I have always been interested in owning, mostly for their strong dividends and reliable businesses, are Snap-on and Stanley Black & Decker. These are mostly industrial, manufacturing, and tools related companies, and their dividends are pretty sweet. Snap-on pays about a 2.5% yield with some excellent growth metrics on it, while Stanley pays closer to 4% and has over 5 decades of growth. To me, Snap-on has the more attractive business, but I'll continue to track both of these stocks for now. Switching over to the biggest losers, though, a few more popular spec stocks made this list as well, with the image social media commerce company Pinterest falling over 20%. They actually had really strong earnings, but they gave poor guidance, so that kind of hurt them. We also saw the cloud computing company Cloudflare fall over 20% because of a revenue miss, as well as poor guidance for the rest of the year. They noted that companies are spending less on their products because of all the macroeconomic uncertainty. And then Snapchat also fell over 20%, which is no surprise to me. I can't even think of a single person that still uses Snapchat. At least I don't know any. It's a little unfortunate, but they continue to struggle. And then also we had the media giant Paramount fall over 20% after announcing a dividend cut with their earnings report as a result of all the heavy costs and spending from transitioning into video streaming. In my opinion, I think the video streaming market is only going to get more saturated over time, so Amazon and Disney, I think, are really the best stocks to invest in if you're trying to get exposure to that market, because they not only have a huge presence in it, but they also have incredibly larger and much more diversified businesses than all these other media companies. And then also on here, we had the Chinese e-commerce giant Alibaba fall about 20%. I'm not entirely sure why it's falling, as they don't report earnings until later this month, but I think it's a combination of investors fearing the Chinese economy's health, as well as maybe the restructurings that Alibaba is going through. But I don't really care. I love to see Alibaba stock fall because it's really my favorite overall Chinese stock to invest in, even though it is risky. But I just feel that they have so much future potential, and I think they're very undervalued here, down almost 75% from the top. We also saw a few pandemic-related stocks falling because of the lower demand for V-shots, including Moderna and BioNTech, both falling over 15% each. I don't own those stocks myself. I do own Pfizer, though. Another Chinese stock I like investing in is Baidu, who happened to fall over 16%, and then US Bancorp also fell close to 15%, which is actually my newest addition to my portfolio. And then finally, I'll just mention a few others here that I don't own myself but are often talked about. Tyson Foods fell 14%. I like their dividend a lot. Square fell 13%. I think that's a good all-around stock. It's kind of underrated in my opinion. I think they have a good price. Roku fell 13%. I want to like them, but I just don't really see a strong enough moat for them. AT&T fell 13%. I used to own them until they cut their dividend. Now I prefer Verizon. Seagate fell 13%. I think there's better semiconductor stocks out there. And Zoom Video fell 12%. I can't understand why anyone would want to own that one when you could just own Microsoft, who gives you exposure to that market too with their Teams video platform, but so much else on top of it too. It's just a much better stock in my opinion. But anyway, that's going to do it for this month's update. I hope you enjoyed it. Let me know your thoughts down below. How do you feel about anything we discussed today? We'll have a chat down there in the comments section. Thank you again for all the support. Please hit that like button if you enjoyed the video. Subscribe. If you want to support the channel even further, you can go to Patreon and you can get on our Discord too. It's a lot of fun. But I just want to say thank you for watching the video, and I will catch you in the next one, my friends. Hope you're all doing well. Take care. Bye-bye.